New day, new lecture, and brand new marks, guys. Like always, welcome to SMAT. Today, it's not a quickie. Today, it's a revision lecture of one chapter that is going to be a lot of marks in your exams. So if you're at CA Inter, also maybe CA Final, but CA Final, I will record another revision lecture. But if you're at CA Inter and giving your exams this year, then definitely this video will get you a lot of marks. Watch it to the end. In the end, I'll tell you 5 tricks and tips on how to get maximum marks in your PGBP exams and why 5 things what you should avoid, what you should not do when you're doing a PGBP question. Guys, profits and gains from business and profession is a very, very important head, and you would definitely find one or even more question from this. So about 20% of your 60 marks of DT will come from PGBP, and let's do it really, really well. I hope you guys are very attentive, and let's do this well. So one of the first things you should know in PGBP is what kind of question comes in the exam. So I told you about 10 to 15% of your paper will be from PGBP. So it's a very, very important chapter. Second, what you should keep in mind is they don't ask you, they don't give you a couple of entries and then you don't need to pass them. Just like a normal PGBP question, they will generally give you a P&L account, or they will tell you there is a profit after deducting a couple of items. So please understand that PGBP can be given a very different way. They can give you a profit and loss account. And if that profit and loss account is given, you will start with the net profit. So what do you do with the net profit? You will eliminate all the things that you don't have to take in PGBP. Example, let's say they put interest income in the net profit or in the P&L account. So that interest income belongs to IFOS and not PGBP, so you'll have to remove it. Also, let's say they put a personal expense in the debit side of the P&L account. In that case, personal expenses are not allowed, and hence that also you have to remove. So basically, you have to do a cleanup job in some questions. At the end of this session, we will also look at one question from the last year's ICAI paper to see how well you understand PGBP. Let's start, guys. As you know, the intention of the ICAI or the intention of the Income Tax Act is not to tax your income, it is to tax your profits. So hence PGBP will start with incomes. So you will take all the incomes and then you will minus all the expenses, only those expenses which are allowed. And once you deduct the expenses, you get profits and gains from business and profession, which will become an income head. This will go into a GTI. On GTI, you will take deductions, you will get to total income, and on the total income, you will calculate tax. That's how it goes. So you'll first determine the incomes, and then you will determine the expenses to get the final PGBP. Let's start, guys. Let's start with the incomes. Guys, the income section, main section is section 28, which is also called the charging section. Section 28, which is also called the charging section, is the income section. This one is definitely going to be used in the exam. If you've been my student, you already know the shortcut. Otherwise, I'll tell you the shortcut, guys. Painkillers can always effectively benefit people. I'll repeat. Painkillers can always effectively benefit people to cure knife cuts and bruises. Guys, these are the different incomes that you can have in your PGBP. The first one is the most common one. That is profits from any business or incomes from any business or profession. Next is any business contract. Guys, if there's any termination or modification of business contract and they pay you some money, then in that case, that money will be income which will be chargeable to tax under section 28. Next, associations like ICAI, when they provide services, specified services to members and they earn certain incomes, that is taxable here. Next, guys, in this is export incentives, example, duty drawback schemes, etc. When you have these schemes, you can either use the drawbacks or you can sell them. If you sell them, that income is not a capital receipt. It's not an asset, guys. It is PGBP income. Next is any benefit. So someone gives you a railway tickets or air tickets free because you did some work for them. As a CA, if I do some work and they give me gold against it, then in that case, that's a non-monetary perquisite, which is a benefit which will be added to my PGBP income. Next is partners, guys. There were 5 partners in a partnership firm. As you know, Syringe and Company. If you've been my student, you know Syringe and Company. Otherwise also, guys, any partnership firm, when the partner earns salary, interest, remuneration, bonus, commission, anything, it is not taxable under different heads like salaries and IFOS. It is taxable under this head because they are doing a business in the partnership firm. Also, guys, share of profit in the partnership firm is exempt under section 10(2)(a). Next, guys, non-compete. If someone tells you not to do something and pays you money, that's a great thing. That will be again your income under PGBP. Next is Keyman Insurance. The shortcut is 6 crores of Keyman Insurance because this is 28(6). But otherwise also, guys, any Keyman Insurance is always taxed. It's unlike a normal life insurance. A Keyman Insurance is taken by the company. So if the company gets the money, then they are taxed under PGBP. If you get the money, it will be taxed under salaries. And if your family members get the money, it will be taxable under IFOS. So Keyman Insurance is always and always taxable. Next, guys, is C, which is basically conversion. Conversion of what? Conversion of PGBP stock In business, you have stock. When you can use that stock and you convert it into a capital asset, on that conversion, they will treat it as income. But what will be the income? You know, because you've not sold it, you've just converted it, the fair market value will be considered as the income. And last is B. So in case of specified business, which you will see ahead in section 35AD, in case of those specified businesses, if you have any income from an asset sale, which we will again see in 35AD, that will be taxable under PGBP section 28. Guys, these are the incomes. You will add up all these incomes to make sure that you've taken all the incomes, and then you will minus the expenses. So this is section 28. Section 29, as you know, we call it the computation section, but I call it the Google Map section for PGBP, because it just tells you one thing: take all the incomes, minus all the expenses, of course, which are allowed, not the disallowed expenses. So all the allowed expenses, and that's how you get PGBP. So this helps you how to compute your profits and gains from business and profession. Not the most important one, not very useful for the exam. Guys, next we start off with expenses. Expenses are really important because in the exam, they will give you a lot of expenses. Some of them will be personal. You shall have to take it out. Some will have, they must have taken an extra deduction. Some they would have forgotten. So please read very carefully the exam question to see what they've done with the expenses. Guys, expenses, please keep in mind the expense has to be for the purpose of the business, and the expense has to be a revenue expense, because capital expense does not go here. It goes into your P&L, it goes into your balance sheet. Let's start with expenses, guys. Section 30 is the first section. Section 30 is based on land and building, basically your office, etc. And any RRTRI. What is the shortcut? Rent, rates, taxes, repairs, and insurance. I repeat, rent, rates, taxes, repairs, and insurance. Rent goes to your landlord. Rates and taxes go to the government. Repairs, of course, goes to the person who's repairing it. Insurance goes to insurance company. When you make these kind of payments, then RRTRI, that is land and building, that will be an expenditure under section 30. But please make sure that this expenditure is only and only revenue expenditure, and also make sure that if you're using the office for even personal purpose, like example, you're staying in one of the floors, then that will be disallowed under section 38. Next, guys, keeping in line the same theme of expenses, section 31 talks about plant, machinery, and furniture. Every business has certain plant, machinery, and furniture. Any repair and insurance, not RRTRI, only RI on that will be debited to P&L. Again, guys, please understand section 31 is only for revenue expenditure, and if it's for personal purposes, example, the car repairs, that will come here, plant and machinery. Car is a plant and machinery. But if you use the car for personal purposes, let's say 20%, so 20% will be disallowed under section 38. Next is the most important section, that is section 32, which talks about depreciation. Guys, depreciation is very important, and in the exam, if they say depreciation has been as per their rates, then please, whatever they minus, let's say depreciation they've taken is 5,50,000 as per their rates, please add it back, because that's wrong. Depreciation only and only has to be as per the income tax rates. So income tax has given you rates, and only as per those rates. I'll just repeat the rates, guys. For building, there are 4 classes. First is building. For building which is residential, why is a residential building? Because you can give houses to your employees, etc., staff quarters. So residential building 5%, other buildings 10%, and temporary structures 40% because they depreciate faster. Furniture is a grade, only one rate, 10%. Intangible assets, only one rate, 25%. Plant and machinery has a host of rates starting at 15% to cars 15%, but cars which are given on hire, etc., higher depreciation of 30%. Ships go slow, so 20%. Aircrafts go faster, 40%. Plants, pollution control equipment, life-saving medical equipment, computers, books, periodicals, all those books, etc., are at 40%. Guys, 40% is the maximum rate as prescribed by the Income Tax Act. So the rates have to be given. If they're not given, you should know the rates on which depreciation is to be calculated. Now for depreciation, guys, there is a twin test. What is a twin test? That you should own the asset. Financial lease is owning, hire purchase is owning. Otherwise also owning is either partly or fully, you should be owning the asset, and you should be using it to a business. So that is put to use is important. The word put to use is important for this twin test. So if you use it and if you own it, then you can claim depreciation. But if you're using it, but if it's taken on rent, then you can't claim depreciation. Whoever is the owner, he will get depreciation. Guys, depreciation as per 2 rates. Let's look at both the sections. Section 32(1)(1) talks about SLM, straight line method. It's only available to companies which are into generation, distribution, and transmission of power. In those cases, they have an option to choose SLM. So SLM basically means if I have an asset for 1 lakh rupees and its useful life is 10 years, so every year I will depreciate 10,000 rupees. So let's say after the first year, the value becomes 90,000 rupees. Now continue with SLM, guys. If you sell this asset for 92,000, then that 2,000 is an income under section 41(2) balancing charge. 2 words, balancing charge. And if the same 90,000 asset is sold for 85,000, so there's a 5,000 rupee loss, which is called terminal depreciation, which is just debited to the P&L account. So SLM will give rise to two things. It can give rise to a balancing charge. Up to the cost of asset, it is balancing charge. Above that is capital gain. And if it's a loss, then it will be called terminal depreciation. Next, guys, the most popular one and the more important one from the exam perspective is 32.1.2, which is basically depreciation on WDV basis. And this one is really, really important. WDV, as you know, is written down value method. And for written down value method, you always need a block of asset under section 43.6. Guys, block of asset means you will have an opening block plus any purchases that you make, you will have to add it. And any sales that you make or any money is receivable, that means either is destroyed in a fire and you get some insurance compensation, any money that is received, you will minus it to get your closing block on which you will calculate depreciation. While you add the purchases, always ensure that is it less than 180 days or not, because guys, if it's less than 180 days, then you get only half the depreciation. So 180 days is very important. And how do you know for your year, guys, financial year 2021, if it's put to use by 3rd of October, forget 180 days. If it's put to use by 3rd of October, then you get full year's depreciation. But even if you put it to use on the 4th of October, then you will get only half year's depreciation. Depreciation is not calculated day wise. It's calculated either full year or half year. So that is 43.6, that is block of asset method. But what is a block, guys? Block basically means the same kind of asset subject to the same rate. Example, a laptop and a car, they're both plant and machinery, but they're not subject to the same rate. So they will be in different blocks. Guys, whenever you've done with this, you also remember the next section in depreciation, that is section 32.1.2a. 2 is WDV and A is additional depreciation. So you get an additional depreciation. It's a one-time depreciation that you get at the rate of 20%. Guys, this is also depreciation. The same rules apply. You should put to use the asset and the asset should be used for 180 days, less than 180 days, more than 180 days. That same rule applies here also. But please remember, in case you put the asset for after 180 days, then you will get 10% this year and 10% next year. It's only a one-time depreciation. So is it applicable on everything? No, not on land and building, not on furniture, not on intangible, only on plant and machinery. And that too, those plant and machinery which are generally used for factories, etc. Because additional depreciation is only given to those people who use these assets for manufacturing business or for power generation business. So not on office appliances, not on second-hand machinery, not on ships, aircrafts, motor vehicles. You don't get additional depreciation. Only on plant and machinery which is new and which is used in the factory or for production or for generation of power. So if they give you a laptop which is used in an office, sorry, no additional depreciation. Depreciation you will get, not additional depreciation. If they say AC in an office, no additional depreciation. But the same laptop and the same of AC are put in a factory, then in that case you will get additional depreciation. Of course, you will also get depreciation. Guys, in case of depreciation, etc., when there is an amalgamation, demerger or succession, ADS, then in that case, what do you have to do? Is it different? No, you don't have to do anything different. Calculate depreciation while ignoring amalgamation, demerger, succession. Ignore it, compute the depreciation normally, and then bifurcate it between the previous entity and the next entity, like the amalgamating company and the amalgamated company, based on the number of days they've used it. So just differentiate that. But while you're doing it, please make sure that if any asset is bought during the year, so let's say if I buy an asset on 1st of December, then you'll calculate half year's depreciation. But then let's say on 1st Jan, if that amalgamation has happened, then for 1 month, you will get the depreciation. For next 3 months, the next entity will get the depreciation. So please ensure that if an asset is bought during the year, the put to use as will be only for those dates from the date the asset has been purchased and put to use. That's about depreciation, guys. Now let's look at another additional depreciation or another aspect of depreciation. Guys, when we're talking about additional depreciation, let me also mention about 4 states, that is BAT, West Bengal. If you've been my student, you know the shortcut. Other people, guys, BAT, West Bengal is Bihar, Andhra Pradesh, Telangana, and West Bengal. In these states, if you use if you purchase any new plant and machinery for the purpose of manufacturing, then in that case, you will get additional depreciation at the rate of 35%. But unfortunately, that period is now over because it is only available from the 1st of April 2015 to 31st March 2020. So that period is now not available, but you should keep this in mind that additional depreciation that time was 35%. Guys, the next section that I really want to look at is 32 AD. Again, also develop these states. Again, this is another one for BAT, West Bengal. But what is this? For BAT, West Bengal, this is not additional depreciation. This is an investment allowance. What is an investment allowance and why is it different from depreciation? Investment allowance is just a normal deduction which goes to the P&L account. It does not go to the balance sheet. It does not reduce the value of the asset. So example, if I bought a new plant and machinery in BAT, West Bengal for 1 lakh rupees, then on this, will I get depreciation? Yes, I will get depreciation. Let's say at the rate of 15%. Will I get additional depreciation? Yes, I will get additional depreciation at the rate of 35%, assuming full year for both. And will I get an investment allowance? Yes, I will get an investment allowance at the rate of 15%, but this one will straight be debited to my P&L account, while these two will be debited to P&L account as well as will reducing from the balance sheet from the cost of the asset. But again, guys, investment allowance is no more because the period is same till the from the 1st of April 2015 to 31st of March 2020. That period is now over. But when you took the investment allowance, you gave them a promise, the government a promise, that you will use this asset for BAT West Bengal for that production business for 5 years. So in case you transfer it or you don't use it for that 5-year period, then that investment allowance has to be reversed. So this could be a year that last year or maybe last year you've taken the allowance and now you got to reverse it. Maybe it comes in your exam in that format. Guys, this is depreciation. Please understand, when you're taking depreciation, you will also have to calculate the cost of the asset really well, and hence section 43.1 comes into picture. Section 43.1 talks about the actual cost of the asset, and it's very simple. Actual cost means all the costs incurred till the asset is put to use. In that, there is 3 explanations, explanation 8, 9 and 10, which are very noteworthy, which we will discuss right away. The others we will discuss as and when they come in the exam, in the chapter. Explanation 8 says that if you pay any interest on the asset, example 8% interest, which we have used as a shortcut, if you pay interest on the asset, then till the asset is put to use, that interest has to be added to the cost of the asset. 9 is basically example, if you pay any indirect taxes, example GST or excise duties or import duty, etc., 9% is what is the example, to remember that. Then in that case, if you've not taken the credit, that's your cost, so it will be added to the cost of the asset. And 10 is, guys, example was 10% the government gave a subsidy. If the government or anyone else gives you a subsidy on the cost of the asset, then that price you have not paid, someone else paid for it, so hence you have to minus it from the cost of the asset. So section 43.1 is linked to the cost of the asset, and basically the higher the cost, the more the depreciation you will get, and the lower the cost, the less the depreciation you will get. So follow 43.1 to get the actual cost of the asset. Guys, these are some depreciation sections, and now we'll move to the next section, that is section 35. 33 and 34 we don't have. Let's go to section 35. Section 35 is research expenditure. Guys, section 35 is a really cool thing, because if you do research expenditure, that's a really nice thing that you're doing. If you're doing it in-house, that means it should be connected to your business. And if it's connected to your business, then any revenue expenditure under section 35.1.1, you will get 100% deduction, not just after you commence a business, but from the date of commencement 3 years prior also, you will get 100% deduction for salaries and raw material only, and salaries without any perquisites. Guys, in case you bought any capital asset under 35.1.4, even the capital asset gets 100% deduction, not just the current year, even 3 previous years. Congratulations, 100% deduction basically means you don't have to wait for depreciation. 100% is deducted in the first year itself. Now, guys, here the value of the asset is 0. So if you're using it for the purpose of business, what will you add to the block is 0, and that is given an explanation 1 to section 43.1. So I'm just linking into section 43.1 as well. But guys, what if you don't? This will be added to the block at 0 value. But what if you don't use this asset for the purpose of any business? What if the research does not go well, or after research you don't start any business? Then what do you do with the asset? If you sell the asset, then if you sell this asset, guys, scientific research asset, 3 words. So under section 41.3, this scientific research asset, whatever price you get for it will be added there, because anyways the value of the asset is 0. So whatever you sell it for up to the cost of acquisition will be added under 41.3. If you get more than cost of acquisition, then you'll go to capital gain chapter. But this is in-house research and 35.1.1 and 35.1.4. Guys, section 35 is now very important, because earlier you would get a weighted deduction of 150%. That means you spend 100, you get a deduction of 150. But that is ended, and it has ended in your year. So from your year onwards, you only get 100% deduction. What if it's outside? Outsiders, if you donate for scientific research, if it's connected or not connected to your business, does not matter. You still get a deduction. Under section 35.1.2, if you're giving money to approved scientific associations, 2A, you're giving it to companies. The company should be an Indian company, and the main object should be scientific research. 3 should be social and statistical research if you're paying money for. And 35.2AA. In this case, guys, if you're giving money to USINs, that is universities, specified persons, IITs and national laboratories, the shortcut is USIN. If you're giving it for that, again, in all these 4 cases, you will get 100% deduction. Guys, 150 used to be earlier, but for your year now, it's 100% deduction, and hence 35 section becomes now very important. Guys, in the exam, they give you that you donated some money and you took 100% deduction. That means it's a correct thing. Don't worry about it. Sometimes the exam, they give you a correct situation as well. Next, guys, after this is section 35D. Section 35D is really important, because if in the exam they say that you started a new business or you started a new line of business to your existing business, then you could have incurred some preliminary expenditure. Preliminary expenditure basically means your typing expenses, your registration expenses, your other expenses, all revenue expenditures like getting a market survey done, etc. before you start a business. That is preliminary expenditure. Do you get a deduction? Yes, under 35 AD you get 1/5 the deduction 1 year and the next 4 consecutive years. In the exam, they could have done a wrong thing by debiting the entire amount, but you'll have to do the right thing by debiting only 1/5 in every year for 5 consecutive years, starting from the year you commence your business. Now, guys, is it unlimited? No, there is a limit to this. First of all, what is preliminary expenditures? In case of preliminary expenditures, which is in the nature of project FEM, that is project report, feasibility study, engineering study, and market survey, it has to be done either in-house or through an approved agency. And the others, you can get it done from anyone. Like the example, registration, you can go to any CA firm or any law firm or anyone and get the registration done. These expenditures are called preliminary expenditures. They will be allowed 1/5, but guys, again here, 1/5 basically means it's not unlimited. It's maximum either 5% of cost of project. If you're on any entity, it's cost of project, or 5% of cost of capital employed, or capital employed, 5% of capital employed. So both 5%, you can choose the higher one. That's a good thing. Cost of project and capital employed both have to be taken in the year you start the business, the last day of that year. So if you start your business on 2021, then 31st March 21 is the date you should take these values from. Cost of project basically means cost of everything, guys, including land, plant and machinery, building, goodwill, everything you can take here, and 5% of that will be the maximum. And capital employed will be equity and preference share capital, the issued share capital, debentures and borrowings. But guys, in case of foreign borrowings, you can take it only if it's for more than 7 years. Guys, in case you have any amalgamation, demerger, etc., then whatever years you've taken, great. But from the year that you amalgamate and the next years, for the remaining years, the next entity will get the deduction. This is section 35D. And D, if you want to remember a shortcut, D is for divide, so you divide it into 5 parts. Another one where you divide again is 35DDA. Guys, I forgot to mention 35D is only applicable to resident entities. That means for non-residents, sorry, you don't get this expenditure, preliminary expenditure. 35DDA is Delhi Development Authority. The shortcut to remember that is Delhi Development Authority when they gave a VRS. So guys, VRS expenditure of any company is allowed as a reduction. Yes, again, 1/5 is allowed every year. But from when? From the year you start paying. After that, 1/5 is allowed every year. That is section 35DDA. We're very close to finishing expenses, and then we'll move to disallowances, guys. That's how the chapter will proceed ahead. Let's now move to the next set of deductions. Next one is very important, section 35AD. Again, here is important because section 35AD shortcut is also develop these industries. Super fast bikes can cover 3 hospitals, 3 workshops, and 3 institutions. This is a shortcut to remember all the different industries which are specified businesses. Guys, this is specified business, as you know: slum redevelopment, fertilizer manufacturing, beekeeping, cold chain facility, cross-country lines for transportation of natural gas, petrol, iron ore, 3H, that is hospitals, 100 beds, hotels, 2-star. Even if you don't run the hotel, you'll still get this reduction. And last is housing, but affordable housing. 3Ws, warehousing of food grains, warehousing of sugar, no other warehouse, no edible oil, nothing else. And last W is water fabrication. And 3Is is infrastructure development. Example, your ports, your airports, your highways, your expressways, etc. Inland container depot, where you store your goods when you export and import. As well as I is iron ore transportation. In these cases, what is the benefit? Of course, revenue expenditure, you always get 100% deduction. But now even for capital expenditure, you will get 100% deduction. Congratulations. And not just this year's capital expenditure, but even if you bought something 4 years back, but you're capitalizing it this year, that means a hospital you're starting and you bought the building 4 years back, but you're capitalizing it this year, the entire cost, you will capital expense, you will get 100% deduction, guys. That's a great thing. And now the value is 0. So what will be added to the block is 0. And this is explanation 13 to section 43.1, just linking into section 43.1. Guys, they give you a heavy reduction. So in this case, this specified business will have a loss. But this loss, now you know, is a unique blood. If you've done set off chapter with me, we do it with a blood bank example. It's a unique blood. So it will only be set off against income from other specified businesses. And don't worry, if it cannot be set off, then it can be carried forward to next year's and it will have unlimited life. This does not have any expiry. Guys, this is a great deduction that you get, and because of this, you need to get your books of accounts audited and also maintain your books of accounts. Otherwise, they will not give you. You have to file a return of income, that too in time, because there's so much deduction. They're giving you 100% deduction. You have to make a promise to take this 100% deduction that this capital asset you are going to use for 8 years. What if you don't use it for 8 years? If you sell it before the 8-year period, then the income that you get will go under section 28(7). There we saw under PGBP incomes that one income from specified business. And if you transfer it to a non-specified business, example, a hospital was turned into a mall, then in that case, whatever benefit you've taken and of 35AD deduction, you will reverse it. but of course you will get depreciation for those years. So example, if you turn it into a mall after 3 years, then the entire deduction that you take 100% will be reversed, but you will get 3 years depreciation, no problem with that. And now the mall will have in its balance sheet the value of the asset less the depreciation. Guys, after 8 years, if you do, no problem with that. Please remember, your plant and machinery can be second-hand plant and machinery. Up to 20% can be second-hand plant and machinery, and even imported machinery which is never used in India will also be considered second-hand. That is, guys, section 3580. Please remember, capital expenditure 100% reduction except goodwill, except land, and except financial instruments. These three things you will not get 100% reduction. So in the exam, if 3580 expenditure is given, they will not tell you 3580, they'll just tell you hospital or multi-speciality hospital, etc. So you have to assume 3580, and in that case consider 100% reduction is a given. This also is important because earlier this 100% used to be 150%. Now from your year onwards and 1 year before that, it's become 100%. So really, really important. Let's go to the next set of general deductions, guys, or sorry, specific deductions. We're left with section 36. So let's do specific deductions right away. Let's move on to specific deductions, guys. Specific deductions are under section 36. So let's quickly do that. 36.1, the first part, 36.1.1 says that any insurance that you pay for your stock, so first you insure your stock, or 1A, anything that you do for your animals. Animals here means cattle, and you means federal, cooperative federal mill societies only. And any insurance payment that you pay for your employees, that is 1B. So first it's stock, then it's animals, and unfortunately then it's your employees. But employees, guys, you cannot pay cash, anything other than cash. And cash means no cross check, no demand draft, no cross demand draft, etc. So the cash, you know what the cash meaning is. So this is insurance premium. Next is 36.1.2, bonus and commission. Two things, bonus and commission. If you're paying to your employees, good, congratulations, you should pay. But you know 43B will come into picture. That means you'll be allowed a deduction only if you make the payment during the year or maximum at the return filing due date. Also here, if you're supposed to pay them dividend, then don't disguise that and make it sound like bonus and commission. That will not be allowed. 36.1.3 is very interesting because every company generally has it, or every entity has it. This is interest payment to any bank, any money lender, any friend, any family will be allowed a deduction because the government will tax the other person. So there's no problem with the deduction, no interest rate, maximum capping, etc. There is no problem here on that. But always keep in mind, guys, that this is allowed only on the business. So if you take some loan to pay income tax, on that is not allowed. Any interest on interest is not allowed. And this will also be subject to 43B, which we will see ahead. 36.1.3A is discount on zero coupon bonds. Guys, in the exam, they give you discount on zero coupon bonds and they debit it in the entire first year only. Don't worry, that's wrong. You will correct it because it has to be divided over the number of months. You'll have to round off months. So anything more than 15 days will be rounded off to the next month. Next, guys, is 36.1.4, 4A and 5. Guys, you know master and slave. Master is your employer, slave is your employee. If the master pays for the slave, provident fund or superannuation fund. 4A is national pension scheme, but only maximum 10% of salary. Salary is BDC, basic, dearness, which forms part of retirement, and commission, which is a percentage of turnover. And 5 is for gratuity payments. If they're making a payment, then congratulations, you as a master or you as an employer will get a deduction here. But please make sure this is also subject to 43B. 36.1.5A is a very unique one because this is employees or the slave's contribution. So if you collected the money from the employee, it's their money. So it will be first be added to your income and then it will be given a deduction. But this is a very strict deadline of monthly due dates, which will be given in the exam. 36.1.6, guys, is 6 animals. Any animals you use for the business at the end of the life or at the end of the useful life, you will take a deduction. 36.1.7 is very, very important, guys. Bad debts. If you want bad debts in your business, you can take a deduction, but only for real bad debts. No provision of bad debts allowed. Guys, bad debts have to be connected to your business and they have to be included in your income. So if my income is 10 lakhs and I have a bad debts of 2.5 lakhs, I can take a bad debt. But if it's allowed, then you get a deduction. If it's not allowed, you don't get a deduction. And then subsequently, guys, if there is any recovery, that will be taxable under 41.4, guys. But for recovery, that means I should have been allowed the bad debts. So let's say 2.5 lakh is allowed as a deduction and I get 1 lakh out of it, 1 lakh will be 41.4. But let's say I take 2.5 lakh deduction. Out of that, I'm not allowed that and I get any income, it is already taxed. So hence no 41.4. So only if it is allowed the deduction, now I'm getting the recovery and hence it will be taxable as income under 41.4. If you've seen my quickie video on 41, that will be really helpful to understand 41 deemed income. Next, guys, is 36.1. Also remember, lending of money is not allowed as a deduction, bad debts for lending of money, unless lending is a part of your business. 36.1.8, sorry, 3619 is 9 kids. That is the shortcut to remember this. Family planning expenditure only allowed to companies, and only allowed revenue expenditure 100% and capital expenditure divided in 5 equal parts. And 36.115 and 16, guys, really important, because 15 and 16 are basically securities transaction tax and commodities transaction tax. But shouldn't they go under capital gain? They are here because you've treated those transactions like trading in securities or trading in commodities, you've treated as a business, so hence they'll be allowed as a deduction here. Guys, this is the list end of specific deductions. Now general deductions. So in case there is no deduction in any of these 30 to 36, example, salary paid to employees, we've not seen salary anywhere. So if it's a revenue expenditure, plus if it's for the purpose of business and profession, then congratulations. If no one else takes it, 37.1 will always take it. So section 37.1 is a residual section where every expenditure can go, as long as it's for business and profession, and as long as it's revenue in nature. But please remember two things that don't go here. Anything which is bad in law, example, any secret commission, etc., you paid, it will not be allowed as a deduction. Any medical referral bonuses, referrals you've given, will not allowed as a deduction, guys, because medical references are banned and not allowed. And next, any CSR expenditure is not allowed, because CSR is not as per the Income Tax Act, it's as per the Companies Act. So CSR expenditure is not allowed. But unless CSR expenditure is one of those listed in section 30 to section 36, example, family planning expenditure, if that's your CSR, or scientific research, if that's your CSR, then you will get it, not because it's CSR, because it is given under section 30 to section 36. Guys, those are deductions. Now over to disallowances. Let's move on to disallowances, guys. Disallowances are those expenditures that you've incurred, but unfortunately they don't allow you as a deduction. So in the exam, please be very watchful of these disallowances. The first one is section 43B. B is in the middle, in between they put a tree. TREEII. Guys, in this case, these expenditures you need to, they are allowed, but only if you make the payment before the year ends or before the return filing due date. Guys, at least by then you should have paid them, make the payment. For tax, any taxes, any rates, any duties, etc., to be paid to the government. Guys, any railway assets that you need to pay to the railways. So example, if you transport goods in railways, please make the payment at least before the return filing due date. 3E is the employees leave salary that you need to pay, employees bonus and commission that you need to pay, and employees benefits that you need to pay, like gratuity, national pension scheme, provident fund, etc. Please make the payment. Next is interest, guys. Any interest that you need to pay to scheduled banks, including cooperative banks, except agricultural cooperative societies. Also interest that you need to pay public financial institutions or state financial institutions. Also interest that you need to pay to NBFCs, including deposit taking NBFCs, and please make the payment, otherwise you will not get the deduction. Guys, electricity charges are not taxes, please keep in mind. And any conversion of interest into loan, that is also not payment. Giving a bank guarantee is also not payment. Payment means actual payment, only then you get a deduction. 43B. It's a temporary disallowance. Don't worry, if you don't pay this year, you will not get a deduction this year, but you'll get it in the year you pay. So let's say your return filing due date is 31st October, but you paid it in the November, then you won't get it in this year. You will get it in the next year, or whichever year you make the payment. Guys, next is section 40A1. Guys, 40A1, and we'll do 40A1 and 1A together. Guys, in both these cases, you're making payments. In 40A1, you're making payments to a non-resident or to person outside India, and 40A1A you're making to a person resident in India. Then in that case, if you have to deduct TDS, you should have deducted TDS. There are two conditions. The deduction should happen during the financial year, and the payment to the government should happen before the return filing due date. If you do both of them correctly, only then you get a deduction. Otherwise, in this case, 100% will be disallowed, and in this case, 30% will be disallowed. But don't worry, if the person whom you're making the payment to, he has filed his return, included the income, and paid the taxes and given you proof, then the moment he's filed the return that year, you will get a deduction. Guys, this is again not a permanent disallowance, it's a temporary disallowance. Don't worry. So in case you've forgotten to do one of the things, that means you deducted it late or you paid it late, don't worry. Whenever you next pay it to the government, you will, in that year, you will get a deduction. For example, in this financial year, if you've deducted it even on the 2nd of April, that is after 31st March, sorry, you will not get a deduction this year. You will get it in the year of payment. So that is a temporary disallowance, 40A1 and 1A. But a 40A3, this is another one. In this case, you're paying salary to outside India to a non-resident. In that case, the salary is treated as a very, very big permanent disallowance if you don't pay the TDS on time. Next section, 40A2. Guys, this is for income tax. Sorry, income tax is not an expenditure for the purpose of business. It's an expenditure because you're doing business, and hence income tax that you pay is not allowed as a deduction. Next, 48(2)B. This is an example of a BEST or bus undertaking. Guys, if the state government undertaking, example, the bus services of Maharashtra or Karnataka or Delhi, in that case, 2B, if that undertaking is paying licenses, royalty, etc. to the state government, then that will be disallowed. Why is it disallowed by the center? Because they were trying to undercut or underreport their profits by paying a huge license fee to the state governments. So if you're making license fee, royalty, and other such payments to the state government, that will not be allowed for state government undertaking. undertakings. Now guys, 40A5, let's do this one guys. In case you are an employer or a master and you're providing some perquisites to your slaves or the employees, and the tax on the perquisite, even the tax you are paying, will you get a deduction of that? No, you don't get your own income tax deduction. Why will you get a deduction of that? So 40A5 is that disallowance. Next is 40B. Guys, 40B is only applicable to partnership firms and LLPs, and in that case 40B4 and 40B5, let's do 4 first. 4 says that you can pay interest. Yes, you can pay to any partner, working, non-working partner, but the maximum rate of interest can be 12% and can be paid only if it's authorized in the partnership deed. Also, interest can be paid only if you have profits and up to the amount of profits. So if your profits are 1 lakh, but you need to pay interest of 1,40,000, you can only pay interest up to 1 lakh. So no going to losses because of interest. Next guys is 40B5, that is remuneration to be paid to partners. First of all, can remuneration be paid to working partners? Yes. Non-working partners? No. Only if it's authorized. And guys, if it's a loss-making entity, then you can pay only maximum 1,50,000 per annum remuneration to all the partners. And if it's profit-making, then split the profits. Up to 3 lakh, you can pay either 1.5 lakhs or 90% of that profit. And above 3 lakhs, you can pay 60% of that above 3 lakh amount. So, and that will be the maximum remuneration you can pay. But please remember, for remuneration, you need to figure book profit. And that book profit is basically after taking all the relevant deductions, including interest deductions, only 12%. Guys, in the exam, they will give you remuneration. They will give you a book profit after deducting remuneration. Whatever they've deducted it, added back, because you need to calculate it as per section 40B5. And also if there's interest deduction, add that back also. First calculate interest deduction and then calculate salary or remuneration deduction. Next guys is 48.2. 48.2 is a very interesting one, because if you're paying excessive or unreasonable amounts, but this is only applicable to expenditure. So if you're making any unreasonable excessive expenditures to any specified persons for individual mean their relatives, for a partnership firm means their partners and their relatives, for a HUF means the members and their relatives, for a company means the directors and their relatives, and also people who have substantial interest. Substantial interest basically means 20% or more in the capital or in the profit sharing ratio. Then to those people, the exam will tell you if it's unreasonable, excessive. You don't have to guess it. And if that is the case, then that will be disallowed, or the excessive portion will be disallowed. But please ensure guys, 48.2 is only and only for expenditure. So if you earn any cash income, or if you earned given a cash loan on that, there is no problem. This is only and only on expenditure that will be disallowed. Next is very important, something that is always there in the exam, 48.3 and 3A. Guys, if you're making payments in cash, then up to 10,000 is okay. Above 10,000 per person per day in cash. Also cross check, also cross demand draft, also a bearer check is not allowed. So you cannot make any cash payment, but this again is for expenditure. Cash income is allowed, cash loan is allowed. That's perfectly okay. And 3 is if you're discharging a liability of more than 10,000 per person per day by paying cash, then that will also disallowed. But guys, there is a rule called Rule 6DD where you deduct. Those are allowed. Those are exceptions. Example, you're paying to the government, or you're paying to a bank, or paying on a bank holiday or a national holiday, or a bank then they're on a strike, or also paying to farmers, agriculturalists, animal husbandry people, or cottage industry without the use of power, or employees when you're paying the last payments on the death, if you're paying up to 50,000 rupees, that payment, or if you're an employee who's out of normal place of business for more than 15 days and he does not have access to a bank account there, that salary that you pay, of course subject to TDS deduction, will be allowed as a deduction under Rule 6DD. Rule 6DD says you will be able to deduct it if they belong to one of these exceptions. Next guys is 40A7. As an employer, you are making gratuity payments, great, but only approved gratuity fund, only payments to LIC gratuity fund, and only payments actually made to the employees will be allowed a reduction. If you make any provision, that provision basically means keeping some money aside, even if it's based on actual valuation, you will not get a reduction. And to unapproved funds, you will not get a reduction. But ultimately from those unapproved funds, when they finally are paid to the employees or to the slaves, then you will get a reduction. 40A7. 40A 9, 10 and 11 says that if you make any payments or any provision to non-statutory funds, something that are not required, like employee annual party or employee holy party, Diwali party, then that provision is not allowed a reduction. When you finally make the payment for that party, then it will be allowed as a reduction under 40A 9, 10 and 11. I hope we've covered most of the disallowances. In case there's something that is left, then you can always look it up from the book. But these are the disallowances. You should keep these disallowances in mind before you actually look at deductions. Guys, next are some provisions which are not expenses and incomes. Those are over. 44AA, guys, shortcut is arrange accounts. So who should maintain the books of accounts? If you're a specified profession means all the parents wanted it to be like a doctor, engineer, architect, chartered accountant, lawyer, engineer, IT professional, film artist, then all these cases basically have some degree to associate it to it. In that case, if in all the 3 previous years, the word is all, so they love all these specified professions, and from all the 3 previous years, if your income is more than 1,50,000, then in that case, you will need to maintain books of accounts as specified in Rule 6F. Otherwise, guys, you can maintain whatever books of accounts you have, no problem. Otherwise, if you cross this limit, then you have to maintain specified books of accounts. For the other specified business, example, any other business or profession which is not under specified professions, then they will not care for all of y'all. So any 3 previous years, if your turnover exceeds 10 lakhs, or if your income exceeds 1 lakh 20, then in that case, you will have to maintain your books of accounts. Guys, for individual HUF, this limit is very small, and hence for individual HUF, this turnover limit is 25 lakh and this income limit is 2.5 lakhs. So in that case, individual HUF has a slightly higher limit. They have to arrange the books of accounts. Once the books of accounts are arranged, you have to store them carefully for 6 years, whether in electronic form or digital format. After the assessment year ends, you have to have 6 years, you have to maintain your books of accounts. Maintain means store your books of accounts. Guys, all and any other keywords for 44AA. Next is 44AB, audit the books. That's a shortcut for AB, audit the books. Who's supposed to be auditing the books of accounts? So if you're specified profession, then if it's more than 50 lakhs your turnover during the year, then you need to maintain the books of accounts. And if you're other than specified profession, then if your turnover is more than 1 crore only, then you need to get your books of account. Guys, for them, they have a special limit of 5 crore. If all the cash payments as compared to total payments percentage is less than or equal to 5%, and also if all the cash receipts are also maximum 5% as compared to total receipts. So payments as well as receipts, both if they are maximum 5%, then you'll get an enhanced limit of 5 crore. That means up to 5 crore, you don't have to get your books of accounts audited. Guys, this is an expenditure because you have to go to a CA and get your books of accounts audited. So you don't have to do it if you are within these limits. Guys, next, we will come back to 44AB because there are certain exceptions. In those cases, you'll have to audit your books of accounts, but we'll come that after we do presumptive taxation. Presumptive taxation is a very interesting situation. But before that, guys, Rule 8, 7B, 7A, and 7, that is composite incomes. This we've also done in a chapter called agriculture income, but I'm just revising it. Guys, in certain businesses, there is a composition of both business income as well as agriculture income. Example, tea, coffee, rubber, and any other business which has a both mix of both. Then in that case, what is business income? In case of tea, it is 40%. In case of coffee, it is either 25% when coffee is only grown and cured. And if it's grown, cured, roasted, grounded, flavored, etc., so many things, and 40%. 7 is rubber business, where 35% is your business income. And 7 is in case you have any connected business like grapes and wine or sugarcane and sugar, then in that case, whatever the market value is will be considered as the transfer value to figure out the business income. Guys, while you're computing the business income, but in the balance sheet, depreciation will happen normally. There will no depreciation of only 40% or only 35% or only 25%. Depreciation will happen normally because whether you use it for business or agriculture, your assets will depreciate it at the same rate. Next, guys, is presumptive income, 44AD, 44ADA. Let's tackle both of these and then we'll also tackle 44AE. There's a small change. We'll have to understand it from here as well. 44AD is for other than specified professions. So other than specified professions, if you want to go under 44AD, you can, but it's only applicable to residents, and which residents? Resident individual, partnership firms, and HUFs, not even LLPs, guys. You can take it. If your turnover is up to 2 crore, then you can take and you can be under 44AD. And 44AD basically means 8% of your turnover or 6%, 8% of normal and 6% of your bank transactions will be your profit. They're assuming the profit. All other things are assumed as expenses. But guys, 44AD is a drug. If you take it one year, you need to take it for the next 5 continuous years, as long as the turnover is within that limit. If you break the chain, in any of the years, let's say 44AD4 is the break the chain here section. In the 4th year, let's say you break the chain. In that year, if you break the chain, then you've done something wrong. So there are 3 things that will happen. In that year, you'll have to maintain your books of accounts and get yourself audited. Example, in the 4th year, in the 5 years that you need to continuously maintain the chain, if in the 4th year you break the chain, then in that year, what you need to do is 3 things will happen. In that year, you have to maintain your books of accounts and get them audited, because how do you showing less than 8%, less than 6% profit? The government wants to know. In the next 5 years after that year, you will not be able to take 4480 benefit of 8%, 6%. And in those 5 years, third thing, in those 5 years, you'll have to make your books of accounts maintained and audited if your income is above the basic exemption limit. Audit only if your income is above the basic exemption limit. Guys, breaking the chain is a very, very difficult thing. So don't break the chain. If you've taken 4481, so you need to take it for the next 5 years, because it's a very, very beneficial thing. In this case, even if 40B4 and 40B5, those are also assumed as deductions. So every deduction is already assumed in PGBP. All the disallowances have already been assumed in PGBP. No other thing in PGBP allowed. But if set off and carry forward losses is there, that is not in PGBP. That is another chapter. So everything from section 30 or everything from section 28 to section 44 has already been assumed when we look at 44AD. Next, 44ADA, it's a very simple section. It is for specified professions only. It is only again for residents. It is again only for individuals, HUFs and partnership firms, not LLPs also. And here you can take this only if your turnover is up to 50 lakh rupees. And here the profit margin is really high for these specified professions, and hence the assumed profit of presumptive taxation is also on 50% of the turnover. So if your turnover is 20 lakh, then on 10 lakh, they will have to calculate your tax. Guys, again, here there is no chain. There is no breaking the chain, etc. And 40B4 and 40B5 are also assumed. All the expenses are assumed. All the disallowances are assumed. You will get nothing else. Now 44AE is presumptive taxation, but again, this one is only for goods carriages. So if you're in the business of goods carriages, example, tempo, etc., and it is applicable to any assessee, not just to individuals, HUS, partnership firms, it's applicable to all assessees. Even if you're a company, you can take it, provided you own only 10 goods carriages in the year. So guys, it's not put to use, it's ownership here. And if you own even one goods carriages, even one extra, even for one day, then you'll not be allowed to take this 44A. So maximum 10 goods carriages in the year. And in that case, what is the presumptive income? For medium and light goods vehicle, it is 7,500 per month or part of the month. So if I have one tempo, even if I bought it on 31st March at the end of the year, I will still have to calculate it as 7,500 into one tempo into 1 month, because even if one day I use it in the month, I will have to consume income as 7,500. Next, for heavy goods vehicle are those goods vehicle whose weight is more than 12 tons, and in that case it is 1,000 per ton. So if it's 15-ton truck, it's a huge truck, so 15 into 1,000 will be my presumptive income. Into how many trucks? Into one truck. Let's say I've used it for the entire year, so into 12 months. This is how you'll calculate presumptive income. Guys, again, here all the expenses are assumed, all the disallowances are assumed, but one expense that is still given here as an exception is 40B4 and 5. That for partnership firm is allowed here in this case 44AE. Guys, always remember 44AD and 44AD and 44AE. If you are eligible to take these, but you are claiming lower than those profits, then you will have to get your books of accounts maintained and get them audited here if your income is more than the basic exemption limit. So please remember, if you fall in these categories, then you got to show at least that much profit. If you're showing less than that profit, then you'll have to maintain your books of accounts and get them audited. Guys, we've taken the incomes, we've taken the expenses, we've taken the disallowances, and we've taken these statutory provisions. Only thing that I've not taken is section 41. Let's quickly look at 41. 41 is also income, but it's deemed income. Why is it different from section 28? Because here, guys, there is no deduction from this income. So you will take 41 and you will not deduct anything from this. 41 has different sections. 41.1 is any liability which is getting ended. So cessation of any liability you had to pay, now you don't have to pay. So section 41.1 says that is your income. Also, if there's any expense you've taken on deduction, but you got a refund, example, sales tax or GST refund, then that is 41.1. 41.2 is balancing charge, which you saw in SLM assets, 2 words, balancing charge. 41.3 is scientific research asset. When you sell that asset up to the cost of acquisition, it is 41.3. And 41.4 is a bad debt recovery. If you've been allowed as a deduction or disallowance, as a deduction under section 36.17, then any recovery of that will be taken under 41.4. I hope you understood this, guys. Now it's time to tell you some things that you have to be careful about. Guys, in the exam, they will give you a P&L account and they will give you a P&L balance, or they'll give you a P&L final net profit, and they will say this is after debiting the following items, crediting the following items. Afterward, you have to keep in mind, because they've already done the things. Now you have to see if it's right, no problem, no transaction, no discussion. If it's wrong, then you have to undo it. Example, let's say they've taken excess depreciation, so they've already minused it. Now you'll have to add it. Next, guys, check the question. If the question says only PGBP income or total income, if they say only PGBP income, then from that you have to eliminate any capital gain, any IFOS, any salary, you have to eliminate that. Next, check in the exam, they're asking for income or tax liability, because those are different things. Also show calculations for depreciation, for anything show calculations, and please understand that not all the adjustments will be wrong, some of them can also be correct. Now let's look at an ICAI question. All right, let's do an examination question, guys. This is the Jan 21 question. Let's try and see. I can't write on the PDF, but I will discuss it on the screen, guys. Mr. Krishna, aged 65 years. The moment they give you age, I'm very sure they will want tax liability. So I'm straight away going to the end question. Please see, to compute the total income and the tax payable, because the moment they give you age, that means they want to calculate the tax also. A furniture manufacturer, that means his business is manufacturing furniture. Manufacturer could mean he gets additional depreciation as well. Reported a profit of 5 crores 64 lakhs 44,700. So you start off with that, guys. So you start off with that number, and please read after debiting, crediting the following lines. So 20,000 paid to Guruvara under 80G. 80G we're not discussing right now because that is under deduction. But guys, 20,000 is paid in cash, and by now you should know cash payments are not allowed. Next one. 48,000 contributed to a university approved and notified under 3512 to be used for scientific research. Guys, you've already debited it. That's the right thing. You should have debited 48,000. In this question, the answer is different because the provisions were last year, so you get a 150% deduction. But for your year, 48,000, if you pay, you get a 100% deduction, which is already given. So perfectly okay. Interest paid 1,67,000 on loan taken for e-vehicle on 15 May 2019 from a bank, which is all good. Next, the e-vehicle was purchased from the personal use of the wife. Guys, personal use is not allowed. So if this is minus, you'll have to add it back. Last, his firm has purchased timber under a forest lease of 20 lakh for the purpose of business. Guys, any expenditure for the purpose of business, you have taken the deduction already because it's after debiting the following items and you've taken a deduction. That is perfectly normal. No adjustment for this one. Let's go to the credits. What has he credited? Income of 4 lakh from royalty on patent registered under the Patent Act received from different resident clients. No TDS was needed to be deducted by any of the clients. Guys, royalty income is not part of furniture manufacturing. So you'll have to remove this from because they've added it. So you'll have to now reduce it because this is not PGBP income. This is IFOS income. Next, assuming guys that's not his business because they've said his business is furniture manufacturing. He received 3 lakh from a debtor. Very important, guys. He received 3 lakh from a debtor, which was written off as bad in the year 2015-16. So a couple of years back, he has written off a debtor. 3 lakh was bad, and now he's received 3 lakhs from the debtor. Sorry, he's received 3 lakhs from the debtor, which was written off as bad a couple of years back. Amount due from the debtor, which was written off as bad, was 5 lakh, out of which the tax officer had only allowed 3 lakhs. So if only 3 lakh is allowed, guys. So total bad debt was 5 lakh, but allowed was only 3 lakh. And now you're getting 3 lakh. So guys, total income was 5 lakh. Out of that, bad debt was 3 lakh. So income was 2 lakh. So now you're getting 3 lakhs. So out of that 3 lakh, 2 lakh is your legitimate income and 1 lakh is the bad debt which you're now recovering. I'll repeat this. Guys, totally you had to recover 5 lakh from that person. So 5 lakh was your income. Out of that, bad debt allowed was only 3 lakh. So 3 lakh is bad debt, but 2 lakh is genuine income, which you're getting now. So 2 lakh is your income, which you're already included. So no adjustment for that. 1 lakh is a bad debt recovery. So you will add only 1 lakh. They've added entire 3 lakhs. So they've done a mistake for 2 lakhs. So you'll reduce 2 lakhs. He sold some furniture to his brother, guys. Furniture is he's manufacturing furniture. So he can sell it to his brother also, guys. 48.2 is only for expenditure, not for sale. So selling is to brother, no problem of 7 lakhs. Sales is not a problem. Only if it was an expenditure, this would have been a problem. Let's move ahead. Other information, guys. Other information means for this, the impact has not yet been given. So you have to give the impact. Depreciation books of accounts is computed by applying the rates prescribed on income tax laws. Congratulations, no adjustment required. Mr. Krishna purchased a new car of 12 lakh on 1st September 2019 and the same was put to use in the business on the same day. 1st September basically means you'll get the full year's depreciation. Guys, this question is for last year, that is financial year 1920, in which year motor car had a double depreciation because they wanted to encourage people to buy motor cars, etc. So hence this is not applicable to your year. But here, guys, just understand if no depreciation for the same has been taken, then you have to take depreciation on cars as a depreciation of 15%. So 15% for the entire year, 12 lakh into 15%, you'll have to take as depreciation. Mr. Krishna sold a house, etc. Guys, house, etc. will be capital gain, which we're not discussing today. Today's discussion is only on PGBP. Mr. Krishna also made the following payments: lump sum premium. So insurance premium will come under a chapter called deductions, not PGBP, and 8,000 paid in cash for preventive health checkup. This is also common deductions, 80D sections. I'm not discussing that right now. Compute the total income and tax payable. Guys, they've said total income. So first you will calculate PGBP. Then if you're removing from PGBP and putting into IFOS, you will calculate those also because you need to have all the heads. You'll get to gross total income. Then from gross total income, you'll minus some deductions. And there's a government donation of 80 GI, which I seen the first thing. And here also there is 80 deductions. I'm not discussing that in detail. I'm just telling you. And then you'll get a total income. And if the total income is there, he's an individual. So you'll apply slab rates up to 2.5 lakh rupees, nothing from 2.5 lakh to 5 lakh to 5 lakh to 10 lakh and 10 lakh plus. And you'll also apply a rebate, etc. because he looks like a resident individual. So you'll also deserve a rebate. Guys, this is 14 marks. Out of that, at least 10 marks is from PGBP. I hope you understand the importance of this chapter. Just stopping the share and talking to you guys. Guys, PGBP, enough said on PGBP. The more you revise, the better you get. And please, after revising and after understanding it, try and do as many exam questions, even if they belong to different years. The provisions might have changed a little bit, but the concepts are still the same. And guys, always and always, please ensure that PGBP is any revenue expenditure and for the purpose of business, because expenses are really, really important. Of course, incomes are important, but that's easier to spot. Expenses are something that you keep in mind. I hope you understood PGBP like a boss. All the best, and over to the next revision lecture, which will be coming out very, very soon. For subscribing, for looking at my updates, etc., please subscribe and also hit the ring bell button and over to the next revision lecture. Thank you.